Hey everyone, welcome back to We Are Cosmic. If you're new here, this is the place where we dive deep into cryptocurrency, blockchain trends, and smart investment moves that most traders completely miss. Today, I've got something really special for you. I've been tracking some of the largest XRP whale movements, and what I discovered is truly shocking. While most traders were panicking and selling their portfolios as the crypto market seemed to collapse into a $311 billion abyss, the whales, the richest wallets in the game, were doing something completely different. And understanding this could completely change how you see XRP and crypto trading in general. Now, I know the charts you see on your favorite exchange can make the market look terrifying. Bitcoin plunges, Ethereum wobbles, and it feels like everything is crashing at once. But here's the key insight: the real story isn't in the candles you stare at. It's hidden in the charging, silent, massive moves of the biggest holders, and the whales who have both information and capital far beyond the average trader. On February 5th, for example, the crypto world panicked as billions vanished in what felt like a heartbeat. Bitcoin stalled, Ethereum shook, and yet XRP did something remarkable. It launched a mock 21% recovery, while the rest of the market bled. That's the kind of event that makes you sit up and pay attention, because it shows a complete decoupling from normal market fear. Here's what's fascinating. The recovery wasn't luck. It was deliberate, calculated, and executed by those who have the resources and know-how to influence market liquidity. While retail investors hit the sell button in a frenzy, the elite were ready with open hands to absorb the supply. They didn't just wait for the bottom, they created it. When you see XRP whale transactions hitting a 4-month high, moving $100,000 or more at a time, you aren't looking at coincidence. You're witnessing smart money in action. These whales didn't just support the price, they forced it back up with surgical precision, buying exactly where liquidity was deepest. Imagine watching a market where the majority of traders are panicking, margin calls are being triggered, and automated liquidation engines are running on full throttle. Most people think this is just chaos, but in reality, it's a buying opportunity for the most well-capitalized players. The V-shaped recovery of XRP on that day wasn't based on hope or hype. It was built on cold, hard capital entering the ledger at record speeds, a textbook example of how whales operate when everyone else is blinded by fear. And that's exactly why I wanted to bring this analysis to you today. If you're holding XRP or even just curious about how institutional players move markets, you need to understand the mechanics behind the moves, not just the price charts. Over the next few parts, we'll break down exactly how these whale movements, liquidity events, and unique active addresses drove this incredible V-shaped recovery. We'll also discuss what it means for XRP's future in the context of institutional adoption, network utility, and supply constraints. So buckle up, because this isn't your typical crypto analysis video. I'll be walking you through why the price bounced 21% while the rest of the market collapsed, how whales set up this recovery, and what that could mean for the next major market move. By the end of this series, you'll have a much clearer view of the smart money effect, the structural shifts in XRP ownership, and why this token might be breaking free from the usual Bitcoin correlation. Before we dive into the charts and numbers, make sure you hit that subscribe button and turn on notifications, because we're about to explore some insider-level insights that are rarely discussed in the mainstream. Trust me, if you're serious about understanding the crypto market, you'll want to follow along closely. February 5th, 2026 was a day that most crypto traders will remember as pure chaos. The market lost $311 billion in value in just 24 hours, and panic was everywhere. Bitcoin plunged below the psychological $70,000 mark, Ethereum tumbled, and most altcoins were bleeding double digits. For retail traders, it looked like the end of the bull run. Automated liquidation engines kicked in, margin calls hit, and the fear and greed index dropped into extreme fear territory almost overnight. The charts looked terrifying, and for anyone holding leverage positions, it felt like a financial nightmare. But here's the crucial point. While the majority of traders were panicking, the largest XRP holders, commonly called whales, were taking action. They weren't guessing or following hype. They were carefully watching order books, liquidation events, and liquidity pools, waiting for the perfect opportunity to buy at deep discounts. While retail investors were selling in a frenzy, these whales were quietly absorbing the supply, setting the foundation for what would become a rapid V-shaped recovery. Let's break this down. During the crash, transactions over 100,000 reached a 4-month high on the XRP ledger. These aren't everyday trades. Each transaction represents significant capital moving from weaker hands, retail traders panicking, to stronger hands with long-term conviction. This process is known in finance as institutional accumulation, and it's a major driver of bullish reversals. Essentially, the whales created a floor in the market. By stepping in at the exact moments when price liquidity was deepest, they were able to force the bottom Xi and set the stage for a rebound. What makes this even more fascinating is the contrast between XRP and the broader market. While Bitcoin and Ethereum struggled to recover even a small portion of their losses, XRP surged odds 21% within days, showing a complete decoupling from the usual market trends. This wasn't luck, it was precision execution. By targeting liquidity where retail traders were selling in panic, whales not only supported the price, they engineered the rebound. The mechanics behind this move are important to understand. When large holders execute transactions of $100,000 or more during a market crash, they are creating price support and triggering short squeezes. While short sellers who bet against XRP were forced to cover their positions as price rebounded, which added even more upward pressure. This is why the V-shaped recovery was so fast and so violent. The whales weren't just buying for a small profit, they were strategically positioning XRP for long-term accumulation and structural ownership changes. This event also highlights an important lesson for retail traders. Price alone is often misleading. During massive sell-offs, the charts can make it look like the market is collapsing beyond recovery. But by analyzing on-chain data, transaction volume, whale activity, and liquidity flows, you can see the real story behind the panic. On February 5th, the charts didn't tell the full picture. XRP's ledger activity, whale transactions, and network fundamentals were quietly signaling that a high recovery was already in motion. Another key factor was how the crash flushed out weak hands. Retail traders who panicked were selling at the lowest point, which created a massive vacuum in the market. Whales then stepped in to absorb this supply, transferring XRP from those with short-term perspectives to those with a tricking long-term vision. This transfer of ownership is critical. It means that the foundation of XRP's recovery wasn't built on speculation or hype. It was built on institutional conviction and strategic positioning. Finally, this event also marked a shift in market psychology. The average investor began to see the market as unpredictable and chaotic, while institutions saw opportunity and leverage. This difference in perspective is what allowed XRP to decouple from the broader market trends. While others were frozen by fear, the smart money was quietly stacking XRP, setting up a structural bullish divergence that would drive the next phase of the recovery. First, let's talk about short sellers and liquidity traps. During the crash, many traders had leveraged positions betting against XRP. When whales started buying aggressively at deep discounts, the price began to rebound. This triggered short squeezes. Short sellers were forced to buy back XRP to cover their losses. This added extra upward pressure, amplifying the bounce. Essentially, the V-shaped recovery was reinforced by the panic of retail traders being absorbed by whale activity. What started as a strategic accumulation by whales quickly turned into a self-reinforcing price surge. Now look at the numbers. XRP didn't just recover, it outperformed every major coin. Bitcoin and Ethereum struggled to regain even minor support levels, while XRP surged ahead by a wide margin. This is what analysts refer to as a true market decoupling. Typically, altcoins follow Bitcoin's lead. If Bitcoin drops, the rest of the market follows. But in this instance, XRP's movement was independent, driven by fundamentals, whale activity, and institutional participation. This shows that XRP is no longer just an altcoin tied to Bitcoin. It is starting to trade on its own merits. One key factor behind this independent behavior is network utility. While the market was panicking, XRP's unique active addresses began to spike, showing a surge in real-world usage. This is different from speculative trading. These transactions include cross-border payments, liquidity provision, and other institutional use cases. When price decouples from network activity, it often signals that fundamental adoption is driving value, not short-term speculation. This is exactly what happened with XRP. While the broader market focused on price charts, the ledger revealed growing structural strength. Whale accumulation during this period was also significant. Large wallets holding anywhere from 1 million to 100 million XRP were actively increasing their positions. These transactions were timed precisely to coincide with retail panic selling, absorbing supply, and creating a stronger ownership base. As XRP moved into stronger hands, the foundation of the recovery became more resilient. This is the classic smart money effect, where long-term holders create factual market stability, even during extreme volatility. Another point to consider is supply scarcity on exchanges. As whales move XRP to cold storage or institutional wallets, the available supply decreases dramatically. This creates a natural supply shock, which combined with increasing demand fuels sharp upward price moves. When you combine this with the V-shaped recovery mechanics, it becomes clear why XRP was able to bounce so quickly, while other assets lagged behind. Finally, let's discuss the broader implications. This decoupling and rapid recovery indicate that XRP is maturing as a financial asset. It is no longer solely dependent on market sentiment or Bitcoin's performance. Institutional adoption, network utility, and strategic whale accumulation are creating a new market dynamic, one where XRP can move independently and sustainably. For traders and investors, this signals a potential paradigm shift. Understanding on-chain metrics and whale activity is now as critical as watching price charts. Why does this matter? Unique active addresses are a direct measure of how many participants are interacting with the XRP ledger. This isn't about traders flipping coins for short-term gains. These are real-world transactions, cross-border payments, liquidity provisioning, and even DeFi activities. The rise in active addresses signals that XRP's utility is growing, meaning more participants are finding real value in the network. When network usage grows while the price is falling or stagnant, it often indicates that the asset is undervalued relative to its actual use. On top of that, institutional adoption has been accelerating. Large financial institutions and banks are now moving from pilot programs to live deployments on the XRP ledger. They're using it for real-time treasury management, cross-border liquidity, and settlement solutions. For these players, a 20% price dip isn't a disaster. It's an opportunity. They are stacking XRP as a liquid, regulated asset that solves a real-world problem: the slow and inefficient transfer of funds across borders. This institutional involvement has another major effect: supply scarcity on exchanges. As ETFs, custodians, and large wallets lock up millions of XRP, the circulating supply shrinks dramatically. Combine this with growing demand, and you get a classic Plaus bullish divergence. Rising demand with decreasing available supply, which often precedes strong upward price movements. In other words, while retail traders panic, the big players are quietly reshaping the market structure. Network metrics also reinforce this trend. The NVT ratio, which compares the network's value to transaction volume, shows that XRP's network activity is growing faster than its market cap. This means the asset is undervalued relative to its real-world utility. Essentially, the ledger is doing more work than the current price reflects, a sign that the fundamentals are extremely strong. When you see this type of divergence, it often signals that the next major market move could be upward once price catches up with utility. Another critical point is whale accumulation on the ledger. Transactions over $100,000 hit a 4-month high during the crash, showing that smart money was actively buying while weaker hands were selling. This created a mind-chain shift in ownership from short-term speculators to long-term holders, coin, which strengthens the network's stability and supports future price movements. These whales are not only accumulating but also removing XRP from exchanges, further limiting supply and increasing scarcity. Finally, all these factors in network utility, unique active addresses, and institutional adoption work together to create a structural bull case on need for XRP. Unlike many altcoins that rely purely on hype, XRP's growth is being driven by real-world use and strategic positioning by the world's largest financial institutions. This combination of fundamentals and smart money activity is what allowed XRP to bounce so sharply during the February 5th crash and sets the stage for sustained growth beyond short-term volatility. In the next part, we'll dive into the role of liquidity, whale positioning, and supply dynamics, in further reinforcing XRP's upward trajectory and why these factors make it one of the most resilient crypto assets in today's market. The impact of this activity is enormous. When large holders accumulate during a market crash, it creates a supply shock. Fewer tokens are available for trading, which automatically increases scarcity. Combine this with growing demand, both from institutions and retail investors noticing the rebound, and you have the perfect storm for a sustained upward price movement. This is exactly what happened with XRP. The whale's purchases created tight liquidity conditions, forcing short sellers to cover and accelerating the recovery even further. Whale accumulation also has a psychological effect. When smaller traders see price bouncing sharply during a crash, they often interpret it as a signal to buy, creating a NNW self-reinforcing cycle. But unlike retail traders, whales are not motivated by short-term gains. They are positioning for long-term structural advantage. This is why these 100,000 plus transactions are so important. They reveal smart money moves that stabilize the market. While retail panic plays out, the combination of liquidity and whale accumulation also explains why XRP's recovery was so fast compared to Bitcoin and Ethereum. While other assets lagged, XRP was able to reclaim lost ground in days, showing that the support was not speculative. It was backed by deep capital and institutional conviction. Large-scale buy orders created a thick bid wall, and as short-term traders scrambled to cover positions, the rebound accelerated even more. Another interesting aspect is the shift in ownership structure. During the crash, retail wallets were offloading XRP, while whale wallets, those holding between 1 million and 100 million tokens, were increasing their positions. This is critical because it means that the market is no longer dominated by short-term traders who panic easily. Instead, the asset is concentrated in the hands of investors with higher risk tolerance and longer time horizons, creating a structural foundation for future growth. Institutional participation also amplifies this effect. Banks, ETFs, and custodians are locking up XRP for liquidity, treasury management, and cross-border payments. This reduces circulating supply further and creates a supply-demand imbalance that favors price appreciation over time. When smart money accumulates while supply shrinks, the market becomes increasingly resilient to volatility, which explains why XRP could bounce 21% so quickly during a market-wide downturn. Finally, this combination of liquidity, whale activity, and supply constraints is a bullish divergence in its purest form. While price initially reacts to panic, the underlying network metrics, institutional participation, and whale accumulation tell a completely different story. The market is being restructured from the ground up, and XRP is emerging stronger with a more resilient ownership base, higher scarcity, and increasing utility. This is why analysts call this a smart money-led recovery. The whales aren't just buying, they're building a foundation for the next leg up. Perfect. Let's move into part 5, focusing on liquidity, whale accumulation, and supply shock dynamics. The forces that make XRP's recovery so strong and its future so bullish. After analyzing the February 5th crash and XRP's V-shaped recovery, one thing becomes crystal clear. Liquidity is king. While retail traders panic sold their positions, the whales, the largest holders, were strategically absorbing the market's excess supply. This wasn't random, it was high calculated accumulation, designed to create a floor and force a price rebound. By moving XRP in transactions of $100,000 or more, these whales were quietly reshaping ownership, taking coins off exchanges and into long-term storage. The impact of this activity is enormous. When large holders accumulate during a market crash, it creates a supply shock. Fewer tokens are available for trading, which automatically increases scarcity. Combine this with growing demand, both from institutions and retail investors noticing the rebound, and you have the perfect storm for a sustained upward price movement. This is exactly what happened with XRP. The whale's purchases created tight liquidity conditions, forcing short sellers to cover and accelerating the recovery even further. Whale accumulation also has a psychological effect. When smaller traders see price bouncing sharply during a crash, they often interpret it as a signal to buy, creating a ennui self-reinforcing cycle. But unlike retail traders, whales are not motivated by short-term gains. They are positioning for long-term structural advantage. This is why these 100,000 plus transactions are so important. They reveal how smart money moves that stabilize the market, while retail panic plays out. The combination of liquidity and whale accumulation also explains why XRP's recovery was so fast compared to Bitcoin and Ethereum. While other assets lagged, XRP was able to reclaim lost ground in days, showing that the support was not speculative. It was backed by Sasaki deep capital and institutional conviction. Large-scale buy orders created a thick bid wall, and as short-term traders scrambled to cover positions, the rebound accelerated even more. Another interesting aspect is the shift in ownership structure. During the crash, retail wallets were offloading XRP, while whale wallets, those holding between 1 million and 100 million tokens, were increasing their positions. This is critical because it means that the market is no longer dominated by short-term traders who panic easily. Instead, the asset is concentrated in the hands of investors with higher risk tolerance and longer time horizons, creating a structural foundation for future growth. Institutional participation also amplifies this effect. Banks, ETFs, and custodians are locking up XRP for liquidity, treasury management, and cross-border payments. This reduces circulating supply further and creates a supply-demand imbalance that favors price appreciation over time. When smart money accumulates while supply shrinks, the market becomes increasingly resilient to volatility, which explains why XRP could bounce 21% so quickly during a market-wide downturn. Finally, this combination of liquidity, whale activity, and supply constraints is a bullish divergence in its purest form. While price initially reacts to panic, the underlying network metrics, institutional participation, and whale accumulation tell a completely different story. The market is being restructured from the ground up, and XRP is emerging stronger with a more resilient ownership base, higher scarcity, and increasing utility. This is why analysts call this a smart money-led recovery. The whales aren't just buying, they're building a foundation for the next leg up.